Hello, everyone. Thank you for joining us today for HCL Technologies Q4 FY’22 earnings press conference. We hope that you and your families are safe and in good health. I am Siddharth Bhatnagar, and I would be your host for today. Before we begin the conference, I would like to share some key instructions with you all. During today's conference, all attendees will be in listen only mode. For the best experience, please select the stack and full screen view on the top right of your screens. If you have joined from your phone, you can double tap on the hashtag HCLQ4 window for better visual experience. There will be a Q&A session at the end of the conference. In case you drop out, please rejoin us using the same invite link. If you experience any technical difficulties, you can message us using the Q&A panel.
Today we have with us HCL Technologies Chief Executive Officer and Managing Director, Mr. C. Vijayakumar, Chief Financial Officer, Mr. Prateek Agarwal, Chief Human Resources Officer, Mr. Apparao VV, and President, Digital Business Services, Mr. Anand Birje. I would now like to hand over to Mr. C. Vijayakumar. CVK, over to you.
Good evening, all of you, and welcome to HCL Technologies fourth quarter and fiscal FY’22 earnings announcement. I hope all of you are doing well. Tomorrow, as you know, is Earth Day, which demonstrates support for environmental protection. At HCL Technologies, we are pacing steadily on our sustainability targets. We recently pledged to limit our greenhouse gas emissions aligned to a 1.5 degrees pathway by 2020 and to reach net zero by 2040. We've also finalized our material dozen commitment with focus areas aligned to create impact across sustainable development goals. There are many programs underway at HCL Technologies, both to reduce our own environmental footprint and also enable our clients' sustainability journey. On a related note, just a few weeks ago, we were named the Corporate Citizen of the Year 2021 by the Economic Times. This award recognizes companies who are flag bearers of social change and champions of good governance across ESG goals. With that important message, let me get into the details of our financial performance. I'm very happy to report that we've delivered yet another stellar quarter in our services business, where the revenue is up 5% sequentially and 17.5% year on year in constant currency. Over the last 3 quarters, our services business has been consistently growing organically at more than 5%, delivering one of the highest CQGR in the industry. We posted a revenue growth of 12.7% in constant currency for the full year FY22. Our services business grew 14.9% year on year, headlined by our digital application services, engineering services, and cloud transformation services. I am also extremely happy to announce that this quarter we crossed a significant milestone. We are now more than 200,000 employees, more than 200,000 ideapreneurs across the world, each day doing their part in creating value for HCL, for our clients, and the communities we operate in. I would like to take a moment and recognize and thank all the employees for their hard work and unwavering commitment amidst the challenging backdrop that we see in the world today. The total growth for Q4 was 1.1% in constant currency. Uh, the services grow 5%, but it's offset to some extent by the seasonally weak quarter in the products and platform business, which continues to be volatile. It came in lower than what we expected. Overall, we delivered 1.1% in constant currency. We're seeing continued momentum and strong relevance of our propositions and strong stickiness with our clients. Our operating margin performance for the quarter came in at 17.9%, and the full year came in at 18.9%. The dip in our margin is largely due to a couple of reasons. One is the seasonality in the P&P segment and the investments that we've been making in growing the talent and scaling up fresher hiring, nearshore scale up, and really investments in training and enhancement of our talent. Also, the lateral hiring continues to come at a higher cost, which is also increasing our costs, which is reflected in our margin performance. However, we believe the investments that we are making in the talent skilling and expanding our global footprint to catch a bigger catchment area for talent, all of that are backed by very strong rationale. And it's our proactive investments in the last few quarters which has helped us deliver a consistent 5% CQGR in the services business and really capture the demand that we are seeing across our client base. We're also witnessing an increased acceptance of leveraging offshore delivery models and global delivery models, especially from Europe, due to the secular talent shortage across many parts of the world and also the emerging geopolitical risks. Our bookings remain strong, cutting across verticals, geographies, and service lines. In fiscal 22, we signed 52 new large deals, of which 35 are services deals and 17 are product software deals. Our pipeline is at a near all-time high and reflects a good mix of large as well as mid-sized deals. While some deals are getting smaller and shorter due to the cloud programs, where customers are phasing the migration to cloud, and there are numerous dependencies, and that takes time. So you see programs are coming in smaller ticket sizes. However, our application development and maintenance, the ADM statement of work, the value is up almost 20% over the pre-pandemic deal sizes. In FY22, strong relevance of our service proposition and very strong client mining has resulted in impressive client additions. Our $100 million clients increased by one. Our $50 million clients increased by eight. From 35, it has gone to 43. We added 22 $20 million clients. We added 30 $10 million clients. We added 31 $5 million clients. And we added 73 $1 million clients. We continue to ramp up the talent. We had a net addition of 11,100 people last quarter. And in the full year, we added 39,900 new additions to our family. I'll share some more details about the performance by segments and verticals. Our ITBS segment delivered an industry leading quarterly year on year revenue growth of 16.2% in constant currency. And it's led by a very strong momentum in our application business, which is successfully riding the strong digital wave. We are witnessing a strong demand for digital transformation services across cloud migration and cloud adoption, application and data modernization, and more importantly, large corporations are really transforming their operating model from a horizontal model to a more product centric operating model, which has been one big trigger for a lot of our application development and management ACV increases that we've seen. Our ERS business continues its steady performance trajectory. We had one of the highest growths in the previous quarter. In the December ending quarter, we had almost 8% growth. In the JFM quarter, we had 3.9% sequential growth and a 23.7% quarterly year on year growth. Our products and platform segment experienced the expected, more than expected seasonality this quarter. It's been a weak quarter for the product business. It declined from a quarter on quarter perspective. We continue to see good leverage points and synergy between our products and services business. In fact, because of the good work that we are doing with some of our clients whom we've transitioned into HCL contracts on the product side, because of the product innovation and the support that we have delivered, we were already seeing a few services RFPs of significant size. And the true value of the product business is really in our client base. And we have 20,000 customers, at least 2,000 customers who have very large potential to spend. And we are already starting to mine the client base for large services opportunities. And we've seen some very good success. As we continue to evolve our product business, we see this as a software startup. It's a big startup. So hence, proactive investments in constant product modernization will continue to remain a driving theme in this business. In terms of our verticals, we saw very strong growth in our telecom and media vertical, which grew at 6.8% sequentially and 20.2% on a year-on-year basis in constant currency. A lot of it is led by the surge in demand in 5G and telecom modernization programs. We also launched two new 5G applications to help mobile network operators optimize their customer experience and reduce energy consumption across their 4G and 5G infrastructure. Our life sciences and healthcare business grew 18.5% and manufacturing grew 16.6% quarterly year on year in constant currency. These were our top performing vertical segments. Financial services had a steady growth of 10.2%, quarterly year on year growth in constant currency. We signed a number of significant deals, one of them with a very large technology company who chose us as their digital engineering partner to enhance their digital engineering capabilities, where we are building three large centers in different parts of the world as a part of their digital engineering partnership strategy. We also signed a large deal in a public sector enterprise, providing an end-to-end support for a lot of the core infrastructure components and modernization of the infrastructure. We also signed a large deal with a European manufacturing company to accelerate the digital transformation journey underpinned by cloud migration and application modernization. We also signed a large deal in a European telecom company where we expanded our partnership to deliver cloud operations and cloud modernization of their infrastructure landscape along with their application landscape, where we have been chosen as the primary strategic partner for all their cloud operations requirements. The needs of all these clients are really reflected in the strength of our propositions. So we remain very optimistic about the outlook for FY23. Uh, the market environment is very buoyant. Our solutions are very relevant, and we have very strong momentum across all the verticals and service lines. With that confidence, we are guiding for 12 to 14% revenue growth in constant currency in FY23. In terms of operating margins, we are guiding 18 to 20% for FY23, as we see continued need to invest in transforming the talent model and to really prepare for the next big wave of the digital spending that's underway in the market. We are entering FY23 with a lot of hope and optimism to continue to generate significant value to all our stakeholders across the board. I will now invite Pratik to dive deeper into our financial performance. Over to you, Pratik.
Thank you, CVK. Good evening and good morning to all the people who are on the call and on the TV. Um, I'll add a few more data points beyond what CVK covered. The first and foremost is, of course, uh, that HCL posted blistering growth in services business of 5.2% CQGR in constant currency over the last three consecutive quarters. So much so that the services revenue in Q4 grew 17.5% year on year in constant currency for the quarter, crossing an important milestone of $10 billion in the last 12 months, delivered mostly organically. In the services business, ITBS has shown strong growth this quarter with 5.2% sequential growth and 16.2% growth on a year-on-year quarterly basis. They have delivered CQGR of 5% over the last three quarters, consecutive quarters. ERS or ER&D, as some of you call it, also showed strong momentum with 3.9% Q on Q and 23.7% year on year growth. They delivered a CQGR close to 6%, 5.9% to be precise over last three quarters. PNP continued to be volatile, degrowing about 13.9% year on year in constant currency. Overall revenue came in at 22,597 crores, say 22,600 crores approximately, growing at 13.3% on a year-on-year basis. Net income or profit after tax came in at close to 3,600 crores, 3,593 crores to be precise, which is 15.9% of revenue, and that has increased 50 basis points quarter on quarter and 100 basis points year on year, resulted into a robust 24% year-on-year growth over the previous March quarter. We have, during the quarter and during this financial year, moved from US GAAP accounting standard to IFRS. And of course, Ind AS continues to be the statutory books in rupees, and in the dollar P&L and balance sheet, we have moved from US GAAP to IFRS. None of the accounting policies has changed, and the past numbers remain substantially the same as the Ind AS numbers published earlier. And the transition date for this is the beginning of FY21, which is the comparable year, which is 1st April 2020. Moving on to the full year numbers, revenue came in at 85,651 crores, and that is an increase of 12.7% year on year in constant currency. And fiscal year EBITDA stood at 24% of the revenue. Profit after tax or net income for the year came in at 13,500 crores, 13,498 to be precise, which is 15.7% of revenue, which on a earnings per share basis comes out to be 49 rupees 77 paise per share. And I would like to also point out that all the year-on-year comparisons, we are excluding the impact of the special one-time milestone bonus, which was paid out in the previous March quarter, which was 728 crores at a EBITDA and EBIT level, and at a net of tax, it was 575 crores. And also in the Ind AS numbers and in IFRS, there is a one-time deferred tax expense of 1,222 crores or $165 million, which was recognized in the previous March quarter on the goodwill of the Project Human, the acquisition of 7 products in the P&P business. So these were one-time aspects in the last March quarter, which depressed the profit after tax for the previous March quarter. And we have not taken the benefit of the lower PAT or lower EBITDA or EBIT in calculating the comparatives for this March versus the previous March. Just sharing some more key metrics. We also had a strong booking performance. The TCV of new deal wins came in at $2,260 million for Q4, which is a 6% sequential growth over the previous quarter. And for the full year, the TCV of new deal wins is at $8.3 billion, which is a 14% growth over the $7.3 billion which we delivered booked last year. Services TCV within this is $2.2 billion, enabled by 6 net new large services deal wins. And the products TCV is $54 million, enabled by 4 net new large product deal wins. And of course, a significant number of smaller deals. The ACV, which is the annual contract value, on a comparative basis year on year, was higher at 21%, reflecting the lower deal sizes and the lower tenures of those deals. To give you a couple of more data points on the cash generation and the cash conversion of the net income to cash, we generated operating cash flow of $735 million this quarter, and a free cash flow of $685 million, which is 155% and 144% respectively of the net income or PAT. For the full year FY22, OCF came in at $2.264 million, $2.26 billion, which is 125% of the annual PAT, and the free cash flow came in at $2 billion, 2043 million to be precise, which is 113% of net income. And our balance sheet remains strong. with gross cash at $2.9 billion, which is up 4% on a year-on-year basis. So, as I already mentioned, the EPS, the fully diluted earnings per share came in at 49.77 for the year, and this is excluding the comparatives that I mentioned before. And the board of HCL has uh, declared a dividend of rupees 18 per share for the quarter, which brings the total during the year to 44 rupees per share. We had declared 26 rupees in the first 3 quarters, and 18 in the fourth quarter brings it up to 44 rupees, which is 88.4% of the EPS of 49.77%. With that, I will hand over to Anand from our digital business, who will talk us through some great performance that they have been delivering. Anand?
Thank you, Pratik, and good morning, good evening to all on this call. I hope you and your families are safe and doing well. Uh, Both Pratik and CVK spoke about the strength and growth of our ITBS services, uh, which has been the stellar performance across the year. Nearly 50% of ITBS services is what we call our digital business. This includes everything we do in digital consulting, both process and design consulting across industry verticals. Most importantly, application services, both managed services as well as transformational services using app modernization, SaaS, and cloud native modernization of applications, platforms, data, and analytics. It was a watershed year for us in digital business as the revenues grew high double digits, as CVK and Pratik already referred, with high single digit constant currency delivery of growth across the quarters, especially the last 3 quarters. And this growth has been strong across regions as well as industry segments, with all verticals generating double digit growth and all regions delivering double digit growth. Over the last 2 years, post COVID, enterprises across every industry have been accelerating their digital investments and in reimagining their business to adapt to the new world. And FY22 growth was clearly driven by enterprises and clients seeking to transform value chains, whether these were B2C, direct to consumer clients, B2B, or B2B2C segments. So literally every industry vertical has accelerated their digital journeys. And there have been 3 or 4 clear trends that created the growth for HCL and for our digital business. Number one, CVK referred to this as the IT operating model transformation happening in enterprises. Enterprises in every industry vertical are realizing that they cannot transform in a waterfall world like they did before, which means planning at the beginning of the year and delivering business transformation through the remaining of the year. But they need to move to more continuous or agile product development type of transformation culture, which means they have to be iterative, they have to be constant in their digital innovation and execution. Our strength in scale agile adoption with experience over the last 5-6 years due to our mode 2 capabilities and journeys that we had been part of in enterprises that adopted similar journeys before helped us become a challenger, and enterprises across the world have been consolidating traditional IT vendors who were traditional application managed service providers who either did not have the incentive to modernize or the ability to modernize the IT operating model. And we've seen significant amount of consolidation led deals, vendor consolidation led deals, where we were brought in as a challenger either to replace existing vendors, existing legacy application vendors or data vendors, or really take over completely from a set of vendors. There were deals across every industry and every geography, and we continue to see this momentum even coming into this year as enterprises transform their IT operating model. The second trend is around modernization with cloud adoption, right, or enabled by cloud. Both applications and data and analytics platforms are being transformed and evolved in enterprises, where enterprises want to take advantage of cloud both for its elasticity, scalability, agility, and resilience. And we are seeing massive modernization of applications and data platforms across enterprises as they adopt more composable architecture and agility in their business. And our strength in modernization, again, combined with our strength in agile delivery, using both cloud native and hyperscaler partners, as well as working with enterprises and reimagining their business processes to deliver such modernization, has been a second sort of key trend in the growth factor for digital business. And the third really is enterprises reimagining value chains, whether these are supply chains, omni-channel commerce, aftermarket services, customer engagement, and delivering these value chains on new adaptable SaaS platforms like Salesforce, Workday, Blue Yonder, or enterprise apps like SAP and Microsoft Dynamics, but really in a more composable, consumable manner, is where we saw massive amount of adoption and transformation. And enterprises wanted capabilities that combined our modern apps capabilities, agile capabilities with SaaS capabilities to deliver these kind of transformations. So those three key levers are trends we see continuing in this year, and we are quite sort of bullish of the digital acceleration agenda continuing going into the new year. Finally, I think some of the bets we took in terms of our partnerships and ecosystems, apart from the hyperscalers and the cloud partnerships that CVK referred to, but partnerships like Adobe and Pega, or SAP, Salesforce, Blue Yonder, and Snowflake, where we've now, over the last 2 years, become one of their elite partners or top partners across the world, delivered some of their best customer success engagements across industries, have also driven our ability to be relevant in the digital spend of the enterprises. Finally, and not the least, talent supply chain transformation has been a huge driver of growth. And really, not just reimagining our talent supply chain, but retooling, reskilling our core talent, as well as senior management around modern digital and agile building blocks, and really building a curious organization has created sort of the growth momentum and our ability to execute and deliver to this demand in the market. In fact, to talk about our talent supply chain transformation and the outlook forward, I'd like to bring in Appa Rao, who's our Chief HR Officer. Over to you, Appa.
Thanks, Anand. Good evening, everyone. Hope you and your near and dear ones, they're all safe and keeping good health. Coming to the employees' wellness and well-being, given the turmoil in the world, I'm really happy to share that all our employees and their families are safe and in good health. From a COVID perspective, we are seeing very few active cases, though in pockets globally we are witnessing some increases. As HCL, our active cases are very less, and our vaccination levels are very high. So all in all, it augurs well for us from an employee well-being perspective. The key area I want to focus, as Anand mentioned, is the talent development. As we all know, we are in a very high demand environment, and the key is talent acquisition, talent development, and talent retention. So I would like to focus on that. But before we cover those areas as a basic hygiene, HCL added a net addition of 11,100 people in the last quarter. And this is across the fiscal year, we added a net of 39,900, which is an all-time high. This is a 23.6% net headcount increase over the previous year. So this reflects well for us in terms of the growth that we have achieved and the growth that we are targeting as we go forward. And our freshers onboarding this year is close to 23,000, 22,859 to be precise. And this is significantly almost a 50% increase compared to the previous year. And going forward in FY'23 as well, we expect that this will be a 50% plus kind of increased numbers what we are seeing. And in the past few years, I mean, if you see how are we focused in getting the talent for HCL, we discussed this earlier that we started a program called New Vistas, where the program, the key underlying theme is how do we take work to the talent where it exists. So the New Vistas locations in India, we had 4 locations, which is Nagpur, Lucknow, Madurai, and Vijayawada. And I'm happy to say that we grew our headcount by 31% in these locations, and we are close to 20,000 people in these 4 locations. Similarly, we have several new frontier countries, New Vistas locations in globally also, like Sri Lanka, Vietnam, Romania, Mexico, Costa Rica, Brazil, and our acceleration there is increasing by the day. So we have really spread our sourcing channels where talent is available, and it augurs well for us in terms of acquisition of talent. Now, in spite of all these efforts, we do realize that there is still a lot of gap in terms of the talent that is required. So our efforts in terms of developing our talent through training has increased manifold in the last couple of years. This quarter, we have done a 2.62 million hours of training, which for the whole year, if I look at it, it is 8.3 million hours of training year on year. And this really has helped us in terms of upskilling our workforce. Just to give an idea, we had almost 4.5 lakhs of trainings in digital skills and 25 lakh trainings in generic skills. And this really has helped us in terms of our internal deployment. In terms of absolute numbers, we have done more than 50% what we have done last year. Overall hiring wise, it's around 41% at offshore and 19% at on-site. And coupled with all these, we also have we are putting a lot of effort in terms of retaining our talent. So our attrition for this LTM stands at 21.9%. And we are definitely seeing that it is stabilizing, if not declining marginally. So we do expect that attrition levels either to stay at that level or come down as we go forward. So coming to gender diversity, we are at 28%, and we have 165 nationalities people with us. So we are doing well, but we have a lot to do in terms of gender diversity. So we have taken very stiff targets, and some of these will be explained as we go forward as part of our ESG strategy. And coming to RTO, or return to office, I mean, we are seeing the footfalls are increasing. We are anywhere between 12 to 15% on any given day in terms of people coming to offices. And if we look at unique employees, they're closer to 50%. So we do see that it is going to be a hybrid work environment for a little while, or maybe permanently. We don't know. We are monitoring the situation, but we are trying to keep our facilities safe for people who are returning to office. And we see a lot of enthusiasm in people coming back, and that augurs well for us in terms of the collaboration that is required, and it creates a healthy ecosystem for HCL as an organization. And as usual, we have been winning a lot of awards. We have been rated as a top employer in 17 countries. And as CVK briefly mentioned, we also have been selected as a corporate citizen by ET. And the Bloomberg Gender Equality Index also for a second consecutive year, we have been selected there. So with these inputs, I will hand it over to Siddharth for Q&A. So over to you, Siddharth.
Thank you, Appa. We will now be opening the floor for question and answer. I request Suraj Bhardwaj to please moderate the Q&A session.
Ladies and gentlemen, if you have joined us from the WebEx mobile app, please tap on the 3 dots on the floating panel on the bottom of your screen, and then tap on the raise hand option. In case you're on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel and we will unmute your line. And in case you have joined on audio only, please press *3 to raise your hand. Our first question today is from the line of Mr. Ayushman. Mr. Ayushman, your line is unmuted. Please go ahead.
Yeah, hello. So my question is for CVK. I believe CVK, you have given a specific guidance after a long time. You can tell me after how long? Because earlier you used to always say double-digit growth, and this time we have actually given a number. So what really gives you the confidence to that's one. And number two, the second one is if you can call out any business impact or on the because of the Russian-Ukraine war. Thank you.
Yeah, Ishman, great question. We always gave guidance till last year. Last year, we gave a little more directional guidance saying double-digit growth. And given all the uncertainties around, we thought we will make it easier for our investors to give a little more precise guidance this year. So there's nothing much to read beyond that on that. Coming to Ukraine and Russia situation, very, very nominal impact. That too, on our product business, we had a little bit of impact because there are a few clients who are consuming our products in some of these geographies, but it's very small.
Thank you, CVK. Our next question is from the line of Ms. Anisha. Ms. Anisha, your line is unmuted. Please go ahead.
Much for taking my question. CVK, just wanted to understand the margin profile has dipped almost 500 basis points from what we had seen in Q3 FY'21. You've of course given the guidance of 18 to 20% margin band, but wanted to understand, will it get worse before it gets better? As in, will H1 FY'23 see more pressure on margins? And when will you see the impact of the investments that you're making in the change in the employee pyramid positively reinforcing the margin number?
Yeah, I'm not sure where you picked up a 500 basis points reduction. I don't think that's correct. But I understand your question more directionally. Yes, there has been a reduction in margin from FY'21 to 22, close to 260 basis points. Now, of course, when we planned for the year, we had planned certain investments to increase sales and marketing investments in our product business. And we were also looking at a lot of new geographies. Incidentally, some of our focus geographies are showing some very good growth prospects. So that was a conscious investment. But as we went through the year, I think as the demand increased, the cost of talent went up significantly during the year. So that was the biggest trigger for the reduction in margins. Now, we have various strategies. Of course, the most important one is we are really increasing the catchment area for talent. We are looking into multiple geographies in Americas, in Latin America, in Europe, and in Asia Pac as well. A couple of very interesting delivery locations are emerging, and that's one. The second aspect is we are looking at significant investments in training and upskilling our talent base so that they can really be delivering to all the new expectations from our customers. And then obviously the most prominent lever here is to increase the fresh talent, both graduates and the Tech B program, which is unique to us. These are various strategies that we are adopting to really address the big supply-demand gap. And we believe towards the second half of the FY'23, the situation should stabilize. From a margin perspective, I don't want to give you a quarterly view of the margins. We are at 17.9, and we hope to see an improving trajectory uh, during the year that's underway.
Thank you, CVK. To the paucity of time, we are taking only one question from everybody. The next question is from Ramita. Ramita, your line is unmuted. Please go ahead with your question.
A couple of queries. First thing, if you could just help us understand this impact on net profit, the sequential and YY basis change in the Q4 net profit, including the milestone bonus, which which you have basically excluded this time, and also another thing I wanted to understand is if you could give us an exact breakdown of the impact on margins from subcontracting, employee costs, and so on, since you mentioned that these have kind of weighed into margins through the year. One other thing would be overall, what is the demand environment looking like? With the geopolitical uncertainties, with the kind of inflation concerns from your larger markets, has that also been baked into the revenue and margin guidance that you have kind of even below analyst expectations, frankly? So yeah, that's all.
So, Pratik, why don't you take the first two questions and then I can address the demand environment?
Sure. So, Romita, first of all, let me clarify so that the understanding is complete. There is nothing one-timer in this quarter or this year's number. The number I spoke about was the impact in the previous March quarter and the previous fiscal year 21. So the milestone bonus that we paid last year was a one-time payout of $100 million, which obviously there was a number of 21.5% EBIT, which is before paying out that $100 million. And after paying out the $100 million, the EBIT reduced to 20.5%. Because our revenue was 10 billion, 100 million is a straight 1 percentage point of that. So this year, when we are comparing versus last year, we are comparing versus the higher benchmark of 21.5% and not the 20.5% is what I was talking about. Similarly, that number of $100 million, when it goes down to the PAT or net income, post-tax, that amount is about $79 million, which again reduced the profit after tax as a percentage of revenue, which is not the comparison point that we are taking. We are taking the higher benchmark without the payout so that it is a tougher compare on a year-to-year basis. I hope that helps you understand. We are taking a tougher comparison point rather than the lower published number as a comparison for the actuals of this year and this quarter.
Yeah, and just talking about the demand environment, we think it continues to be quite robust. We haven't seen any significant impact because of the current situation. We believe we have a very balanced portfolio, which will benefit a lot from the discretionary spend, and which will also benefit significantly when the environment is a little tougher, because we have some of the strongest operations propositions in the industry. So overall, we feel pretty confident of the demand environment, and that's also enabling us to provide you the guidance for the coming year.
Thank you, CVK. Our next question is from the line of Ms. Surabhi. Ms. Surabhi, your line is unmuted. Please go ahead with your question.
everyone else. I just wanted to understand that, as far as the numbers are concerned, why not give actuals? I understand the point that Prateek was making of taking a tougher standpoint, but why not share actuals? So could you just help us give out the actual numbers instead of excluding these two points?
Sure. We have shared the actual numbers, Surbi. So I'll repeat since you are asking for that. So the numbers, for this year, the numbers remain the same, which is EBITDA of 24%, EBIT of 18.9%, and profit after tax, which is 15.7%. It is only the comparison point where that what I talked about becomes relevant. You are right. What is the number this year is frankly all that matters.
Thank you, Prateek. Next question. I think Ms. Surbi has a follow-up. Yes, Ms. Surbi.
Thank you. So, CVK, I also wanted to understand from you that you've said that the products and platforms business has contracted and it's been hit by seasonality. Could you just explain what kind of seasonality is this, and why is the impact been so severe?
Yes, Surabhi, see, the products and platform business has two streams of revenue. One is the subscription and support, and the second one is new product sales. So, about two-thirds of this revenue that we have in our product business, which is about 1.4 billion, is subscription and support services, which is fairly stable, and it follows a growth pattern like most other businesses. However, the seasonality is really coming from the new product license sale. And our endeavor has been to convert as much of new license sales into more of a subscription based contracting models, so that we are able to increase the annuity nature and reduce the fluctuations. This is a long term business transformation, and it will take some years. Till then, you're going to see the volatility that you've seen in this business.
Thank you, CVK. Next question is from Ms. Shivani Shinde. Ms. Shivani, your line is unmuted. Please go ahead.
Good evening, gentlemen. Congratulations on the numbers. CVK, this question is for you, and I'm probably asking, it's a repetition of what Ayushman asked. Guidance of 14 to 18% on the back of 13.7 or 6% growth, I'm talking in Indian rupees now, looks quite robust. And the statement that you made, we just want to make sure that in so much of uncertainty, we give some kind of stability to the investors. But that's an interesting comment and an interesting situation. In uncertainties, you're giving a quite bullish guidance. Tell us a little bit more about it, the confidence that is coming from here. And the second question is, if you could also throw some light on the IBM acquisition. I know it's been 2-3 years now, but how have that panned out in terms of new business or new clients onto those platforms?
Yeah. I think, first of all, I want to clarify our guidance for FY'23 is a constant currency revenue growth to be between 12 and 14%. That is the guidance that we have given. On the operating margin, we are saying it is between 18 and 20%. So this is based on a pretty strong momentum that we've seen in the past 3 quarters. As I said, our services business has grown 5% this quarter, and last 3 quarters CQGR of our services business is 5%, which is higher, which is probably the highest in our peer group. So we have a good momentum going. We have a very good talent supply chain which is working for us, and that's something which we think will continue into the year. So based on what we have to fulfill, based on the order book that we have, and the strong pipeline which is at an all-time high, with all this, we concluded that we will deliver between 12 and 14%. And yes, there is uncertainty, and we have factored some of the uncertainty into this mix. But we will keep updating you as the year goes by.
The second question on the IBM acquisition, the platforms that you
Yeah,
acquired from
yeah.
the.
Yeah, sorry, we didn't acquire IBM. We acquired a
Sorry,
few
no,
products.
yes, sorry, yes.
Yeah.
I stand corrected there.
Yeah.
Yes, sorry.
So,
Some of the products that you acquired.
absolutely, I think the rationale for this acquisition was twofold. And I want to once again reiterate that first is to have market permission to play in the product space, which is phenomenally successfully achieved. We have 18,000 customers for whom we provide software products, and we have software license agreements. We have a sales channel across the world. We have business partner channel across the world. So we have market permission to play the software product business. The second aspect is the client base that we acquired. The install base for these products are phenomenal. Pretty much every large company in the world uses some software product or other that we have. Like we have 1 million endpoints which are supported by BigFix. We have 200 billion of e-commerce which gets transacted on our e-commerce platform. We have 10 million touch points every day on our marketing automation platform. Some of the biggest companies in the world use our marketing automation platform. So it's the client base that is a strategic lever. And as I mentioned, we are already seeing a good synergy playing out between our client base, for whom we have done a lot of product innovation. We deliver some exceptional services where clients are bringing in, and we already saw a few sizable proposals, requirements coming from this client base. So I think on these two fronts, this has been very successful. Of course, this product business should be looked at like a big startup, and there will be ups and downs, but we will stay the course. We feel pretty confident of what can be accomplished in terms of financial performance in the long run.
Thank you, CVK. Unfortunately, due to paucity of time, we will be able to take only one more question. And in case you have any more questions, please email them to us. Our last question of the day is from Ms. Swati. Ms. Swati, your line is unmuted. Please go ahead.
So I have like two questions. One is about the geopolitics, which you already mentioned, but I would like to know about the Sri Lanka operations. So with the current crisis unfolding in Sri Lanka, so how do you look at this operation? Do you look to expand further, or is the current crisis going to impact your expansion in Sri Lanka?
Yeah, Appa, do you want to address that?
Yeah, Vijay. Hi, Swati. The Sri Lanka situation is twofold. One is the inflation that is running high there. Second is the essential supplies, especially diesel for generating power. Last month there was a bit of a hiccup in terms of 13-hour power cuts. But with all the credit lines they have from Indian government and the supplies that are coming in, it has reduced now to 3 to 4 hours. And we are able to correct the wages of people and adjust it to inflation and affects depreciation. So those from an employee standpoint, they have been taken care. And we are not seeing any miss in our deliverables. People are able to work. We are able to provide UPS for them, and our offices are open. So the return to office is almost 50 to 60% there. And we are treating it like a BCP situation and then providing all the support. And we are even ready in case there is any emergency. We are ready to airlift our people to Indian locations. But right now it is business as usual. The odd hiccups are there, but not so much that it disrupts our business at this point in time.
But would it affect your further expansion? I think the office you had, I think, open can hold 4,000 people. I think you have hired around 1,000 people in Sri Lanka. So is there a pause in the expansion in Sri Lanka?
No, we are 2,000 people strong already, and we have not seen any slowdown in terms of recruitment. Right now, the plans are continuing, but we are closely watching the situation.
Okay. The other one is about the in the light of the crisis, both the Russia-Ukraine conflict and the inflation in the US. So, are you seeing any step back from the client spending, or is there like are the decisions taking longer? Do you see this impacting the growth, especially in the European region, or even the client spends in the next couple of quarters?
We haven't noticed any significant difference. There are obviously there are some impacts here and there, but nothing to be called out at this point, Swati.
That was the last question. We had time only for those many this time. That ends the Q&A session. Back to you, Siddharth.
Thank you, Suraj. And thank you, everyone, for your valuable time and presence. Please note, the recording of this webcast will be available on the HCL Technologies website. With that, we conclude this press conference. Thank you once again for joining us. Stay safe and take care.